The gig economy has caused a major shift in the way that work is done. The flexibility and convenience brought by the gig economy have attracted millions of people around the world to offer their services and skills to a range of platforms. The gig economy also brought about a wave of startups and companies that have gained significant traction in recent years, such as Uber, Lyft, and Airbnb, to name a few. However, despite the hype surrounding these companies, many of them are yet to show a profit. In this essay, we will examine the reasons behind the lack of profitability in gig economy stocks. One of the primary reasons behind the lack of profitability is the low barriers to entry. The gig economy has attracted a range of new entrants, from entrepreneurs to small-time business owners looking to make a quick buck. This has led to fierce competition among players as they struggle to acquire market share and offer competitive prices. However, the high level of competition and commoditization of the services offered has led to a downward pressure on prices, making profitability increasingly difficult to achieve. Another factor contributing to the lack of profitability in the gig economy is the high cost of customer acquisition. Gaining new customers is often a costly and time-consuming process, requiring substantial investments in marketing and advertising. In many cases, customer acquisition costs can outweigh the revenue generated from that customer. This is particularly true for gig economy companies that rely on a relatively small customer base, or where there is only a limited potential for repeat business. The rise of the gig economy has also created complex legal and regulatory issues. This is especially true for employment and labor laws, which have come under scrutiny in many countries, leading to some companies being forced to pay their workers as employees rather than independent contractors. This has a significant impact on the costs incurred by companies in the gig economy, including payroll taxes, benefits, and other labor-related costs. Also, with the adoption of new regulations and safety practices, companies have to incur additional costs, consequently affecting their profit margins. Finally, the gig economy is a relatively new and untested market, with many unknowns that make it difficult to forecast future performance. Market conditions can quickly change, and competitive pressures can suddenly shift, making it hard for companies to predict the potential for future profitability. In conclusion, the lack of profitability in the gig economy stocks is due to multiple factors, including intense competition, high customer acquisition costs, regulation. How long can these zombie companies keep going? Could the gig economy last 10 years, or could it come to a crashing halt, or is this beginning of techno-utopian future? Tell me what you think in the comments section.